The Market Maker's Edge by Josh Lukeman provides insights into the mindset and strategies used by professional market makers. Today we dive deep into technical strategies and order flow dynamics, which are essential to executing trades effectively. A detailed breakdown of these two chapters, expanding on the key concepts and providing actionable insights on how to use them to develop profitable trading strategies. Chapter 6 focuses on technical analysis techniques that market makers and professional traders use to identify high-probability trades. Lukeman emphasizes the importance of price action, key levels, volume, and market psychology in making informed decisions. Support and resistance, the foundation of market structure. Lukeman highlights the importance of support and resistance levels, which act as psychological price barriers. Support levels are price levels where demand is strong enough to prevent further decline. Smart traders use these areas for buy entries when they align with strong order flow. Resistance levels are price levels where selling pressure overcomes buying momentum. A trader should be cautious when longing near these areas unless a breakout is confirmed with volume. How to use this for profits? Look for liquidity pools near key support/resistance zones. If you see repeated tests of support without a breakdown, it signals strong demand, making it a good long entry. Combine support/resistance with order flow data, discussed in Chapter 7, to determine whether large institutions are accumulating or distributing. Moving averages and mean reversion strategies. The book discusses using moving averages, MAs, such as the 20, 50, and 200 period MAs for trend confirmation and identifying entry points. Short-term traders focus on the 20 period MA for quick reversals. Swing traders use the 50 period MA as a dynamic support/resistance level. Long-term traders rely on the 200 period MA to confirm major trends. How to use this for profits? If price bounces off a moving average with strong volume, it confirms a valid support level. Use mean reversion strategies by looking for deviations from the moving averages. If a stock is too far from its 50 MA, expect a pullback or reversion to the mean. Market makers often fade extreme moves, so be aware of overextensions. 3. Volume and price confirmation. Volume is crucial for confirming breakouts and reversals. Lukeman stresses that low-volume breakouts are weak and likely to fail, while high-volume breakouts have conviction. How to use this for profits? Breakout strategy. If a stock is breaking resistance with above-average volume, it is more likely to continue. False breakout trap. If a stock breaks resistance but the volume is weak, market makers might be baiting retail traders into buying before selling into them. Watch time and sales data for confirmation. Chapter 7, Order Flow and Liquidity, How to Read the Market Maker's Hand. Overview. This chapter focuses on liquidity and order flow, which are critical for understanding how smart money operates. Market makers manipulate liquidity to execute trades efficiently, and retail traders who fail to recognize this are at a disadvantage. Key concepts and in-depth analysis. 1. Understanding liquidity and market depth. Market makers thrive on liquidity, which allows them to execute large orders without causing extreme price swings. High liquidity environments, e.g., SPY, AAPL, QQQ, offer tight bid-ask spreads, reducing trading costs. Low liquidity stocks have wider spreads and can be easily manipulated by market makers. How to use this for profits? Look for liquidity traps. Market makers often stack fake orders in the order book to mislead traders. If you see a large bid that suddenly disappears, it was likely a liquidity mirage designed to trick buyers. Trade in liquid markets. To avoid unnecessary slippage, focus on stocks with high daily volume and tight spreads. 2. The role of dark pools and hidden orders. Lukeman introduces the concept of dark pools, where institutional traders execute large orders without showing their hand in the order book. How to use this for profits? Use Level 2 data to watch for hidden liquidity zones. If price stalls near a level without visible orders, it could be due to dark pool accumulation. Watch for sudden bursts in volume that aren't reflected in the order book. This often indicates institutional interest. 3. Market maker manipulation and traps. Lukeman explains how market makers manipulate price action to force retail traders into bad positions. Common manipulation tactics. Stop hunting. Market makers push price below support to trigger stop losses before reversing the move. Liquidity sweeps. They create the illusion of a breakout, attracting traders in one direction before reversing sharply. Bid/ask spoofing. Placing large fake orders to influence trader sentiment. How to use this for profits. Avoid chasing breakouts. Wait for a confirmation candle on volume before entering. Look for liquidity zones where price is artificially suppressed. These are often accumulation zones. If price suddenly drops to a key support level and immediately recovers, it's likely a liquidity grab rather than a true breakdown. Final thoughts. Developing a strategy based on these concepts. To use these insights effectively, combine technical levels with order flow. Support/resistance works best when confirmed by liquidity patterns. Use moving averages and volume as confirmation. If price touches a key MA with increasing volume, it's a strong signal. Trade with institutions, not against them. Look for hidden accumulation areas and avoid chasing momentum without liquidity backing. Monitor level 2 in time and sales data. This reveals whether orders are real or fake, helping you avoid traps. Understand market maker psychology. Institutions profit by exploiting retail trader emotions. Learn to think like them. By integrating these techniques, traders can significantly increase their probability of success and avoid common pitfalls that market makers use to exploit uninformed participants.